Welcome to the Apprentice Trading Library. In this segment, we will provide you with an introduction to sector rotation. Did you know that different sectors of the stock market move in predictable cycles? Big money, hedge funds, institutions, and smart investors rotate between sectors as the economy shifts. Understanding sector rotation can help you anticipate market trends and make more profitable trades. Let's break it down. Sector rotation is the process of capital moving between different industries as the economic cycle changes. It's based on the idea that not all sectors perform well at the same time. For example, when the economy is expanding, growth stocks tend to outperform. But when a recession hits, defensive sectors like utilities and consumer staples take the lead. The economy moves in cycles, and each phase affects different sectors differently. Expansion. When the economy is growing, sectors like technology, consumer discretionary, and financials tend to thrive. Peak. As growth slows, commodities and industrials perform well as inflation rises. Contraction. When the economy weakens, defensive sectors like healthcare, utilities, and consumer staples become attractive. Trough. When recovery begins, energy, materials, and cyclical sectors start leading again. Recognizing where we are in the cycle helps traders stay ahead of the curve. To spot sector rotation, watch these key indicators. Relative strength. Compare sector performance against the overall market. Stronger sectors indicate where smart money is flowing. ETF and mutual fund flows. Big investors move capital into sector-specific ETFs when they see opportunity. Earnings. Trends. If earnings growth is accelerating in a sector, expect institutional money to follow. Interest rates and inflation. These affect which sectors benefit. Rising rates help financials, while low rates boost tech. Here's how traders can capitalize on sector rotation. Follow smart money. Watch institutional fund flows and relative strength rankings. Use sector ETFs. Instead of picking individual stocks, invest in sector ETFs that track industry performance. Stay ahead of the cycle. Look at economic indicators to anticipate which sectors might gain momentum next. Diversify over time. Rotate portions of your portfolio instead of making sudden moves based on short-term trends. Successful traders don't fight the trend, they move with it. Many traders struggle with sector rotation because they fall into these traps. Chasing past winners. Just because a sector was strong doesn't mean it will stay that way. Ignoring economic data. Sectors move based on macroeconomic shifts. Watch for changes. Overtrading. Constantly shifting between sectors can rack up fees and hurt long-term returns. Instead of reacting emotionally, follow data-driven sector trends. Many traders struggle with sector rotation because they fall into these traps. Chasing past winners. Just because a sector was strong doesn't mean it will stay that way. Ignoring economic data. Sectors move based on macroeconomic shifts. Watch for changes. Overtrading. Constantly shifting between sectors can rack up fees and hurt long-term returns. Instead of reacting emotionally, follow data-driven sector trends. Sector rotation is how smart money flows through the market. By understanding economic cycles and watching sector trends, you can make more strategic investment decisions. Want to trade like the pros? Visit verifiedinvesting.com for expert insights and strategies.